Hi everyone, so we're going to have a run through of this sample assessment material for Enterprise, and this is of course Level 2 Enterprise, Component 3 for BTEC Promotion and Finance for Enterprise. So this is the external assessment, so let's get right on into this. Now, here's the case study information, okay? Let's have a little run through here and just make sure that we really draw attention to some of the key points. So this is someone who's been interested in crafts since he left art college. This interest led to him setting up a candle making enterprise, okay? So we want to be clear on that. The enterprise also offers candle making workshops, all right. Damien started the enterprise 3 years ago. He is not experienced in managing the finances of an enterprise and finds this part of running his enterprise difficult. Okay, so we've got to help him out with his finances here. He makes the candles himself, so they're handmade, so that's important in terms of the actual market size that he's actually targeting. So it means that it's going to be somewhat limited because he's making them himself. One area the enterprise is keen to expand is the candle making workshop. Okay, so he wants to expand the workshop sessions here, where customers can create their own candles. In recent months, that's just worth us highlighting that as well. So customers can create their own candles here. In recent months, the number of customers for these workshop sessions has fallen. Damien is not sure why this has happened. Okay, so again, this is some quite nice sort of application that we've got. He's got falling customer numbers. He's not sure why that's happening, but it's affecting the profits of his business. Damien wants you to help him improve the success of the candle making workshops and to help with the general financial management of the enterprise. Okay, so let's run through the questions. I just want to keep that handy, that case study information there, okay? So I'm sure we'll come back to that at various points here. So let's start off with the first question here. Damien has a number of questions about the appropriate financial documents to use. State the name of the financial document that is used to check materials when they arrive from suppliers. Okay, so at any time here, you can pause the video and just have a go at answering these questions and just see how you get on, all right? So, of course, pause now before we run through the answers. Okay, so what document is that? Of course, the delivery note. So the delivery note will actually tell you what documents are actually included and what has actually been incorporated with that delivery, of course. Right, so next we've actually got to match up these different financial documents and their purposes. Complete the diagram by drawing arrows to match the financial document to its purpose. An example has been completed for you. Okay, so we've got that information about the credit note to correct an error on a customer account. Fine. So let's move on to the next one. So the purchase order. So let's just run through these. And we've got a purchase order down here to identify goods ordered from a supplier, of course. So this is an order that you're actually putting through to your supplier. It just sort of makes sense from the actual name, doesn't it? Purchase order. So then we've got receipt. So to confirm a customer has paid a bill. So that would of course match up. And then we've got statement of account to list orders and payments that have been made. So that fits nicely there. Great stuff. Okay, so we're on to sort of 4 out of 4 here. Lovely. Now, next questions. All right, let's just move that out of the way so I can centralize this. So, in the past, Damien has made a mistake on his invoices, which meant that customers were asked to pay too little money. Explain one impact this mistake would have on the finances of the enterprise. Okay, so with these questions, just notice we've got 2 marks. We've got to give one impact, so it's no good stating 2 impacts. So you've got to really make sure that you develop the point that you actually state. So you've literally got to think about actually stating a point and then explaining. So it's almost like a point and explain. Okay, that's got to be the approach that you use to actually get 2 out of 2 here. Right, so what could we do? Well, it may well mean that sales revenue would be lower. Okay, so sales revenue, net sales would be lower. Okay, so we can say revenue would be lower. Okay, fine. So we can then think about our explanation, and incidentally it can be helpful just to actually think, right, I'm going to state my point, and then in the row below I'm just going to explain it, and really it shouldn't take much more than a sentence. Okay, so why could this be the case? Well, it's because he hasn't received the actual correct money. So failing to receive correct money for each order or for each sale. Alright, so that would work nicely. And once again, we're on to 2 out of 2. So lovely stuff. Let's move it through then. Now, you can give any sort of reasonable answer here. Don't think that the answers that I'm giving are limited to simply that. As long as your answer makes sense in the context of the business, absolutely fine. Right, so let's move it on to the next one. I'll just zoom in a little. So, Damien sells his candles in both business to business and business to consumer markets. Explain one benefit to the enterprise of Damien choosing to sell the candles in the B2C market. Well, it may mean, of course, that he can actually charge the higher price because it's not like he's dealing with a sort of intermediary here, so someone in the middle, a middleman, and that means that he may be able to actually charge a higher unit price. Okay, so we could say, right, charge higher unit price, and why is that a benefit? Well, it will mean, of course, that the actual profit margin on each unit is higher. So that would also work as well. Now, you could also say that you're selling it directly to the customer. So anyway, I'm just going to go with that first point that I've highlighted there. So it means increased profit margin put on each unit. Okay. Right. So again, just notice what I've done here. That identification is one mark, and then the development at that point, the explanation, is the second mark. Okay, great stuff. Right, so let's move it through. Now, we've got some numerical information now to use. So let's have a little look at what we've got here. So Damien has delivered an order. Let's just get all of that in the screen there as well. So there we go. Damien has delivered an order to a customer and now needs to be paid. He has sent you the following email giving information to include in his invoice. Can you create an invoice? 250 scented candles. Just notice these prices, notice these amounts. So we've clearly got to do 250 times £8.50. Okay, so 250 times £8.50, and where will that go? Well, that will go down here, and there's one mark available for this. And don't be afraid to actually write on the paper as I'm doing now, so it can just help you to get your answer organised. And then we've got 275 times £4. As a loyal customer, they should get a 10% discount on their order. Postage and packing should be charged at our standard rate of £40. Well, that's it already in there, okay? So there's that information. So as we run through these calculations, you may just want to have a go at actually calculating this amount. Okay, so 250 times £250 times £8.50, that comes to 2,125. Then we're on to 1,100. Next up, our total price thus far we can then see is 5223. So we can see 5223. Okay, so very nice. So that means a 10% discount of that is, of course, going to be, what, £322.50. So £322.50, and it might be helpful when you complete anything like this just to keep it in your units, your tens, your hundreds, your thousands, as I'm doing here. Okay, so it might just help you keep all of that information organized. So now our subtotal, we've of course got to subtract this. This needs to come off that amount. And what does that leave us with? Well, that leaves us with £2,902.50. And then we've got the postage and packing to add on. So that will of course mean that we've got 2492. Okay, so £2,942.50. Okay, so then there's 6 marks available there. Great stuff. So let's have a look at what we've got next. So when Damien sells his candles, he accepts a number of different payment methods. One payment method that he accepts is cash. Give 2 other payment methods that customers can use to pay Damien. So how else could he be paid? Like, this is an absolute steal, isn't it? Okay, so debit card, of course. Lots of people make contactless payments now for amounts below £30, so that would work very nicely. And then you could also put down credit card, but other potential answers are also acceptable here. So it could be that you say something about Android Pay or Apple Pay or something like that, and that's acceptable. Okay, what isn't acceptable is repeating cash. Okay, all right, fine. So this is looking good. Let's move it on to 2C. Explain 2 impacts Damien would need to consider when allowing customers to pay for goods with cash. So 2 impacts Damien would need to consider. So again, we can see it's 4 marks. It's an explain question, so we've got to give that point and then the development, okay, of that point. So what does he need to consider when allowing customers to pay for goods with cash? Right, so first up, he's got to think about safe storage. So that means that he's got to be sensible about the way in which that he manages this cash, and he doesn't want to be holding on too much cash. So that's obviously important. Okay, so we can then just develop that point by saying, right, he should not hold too much cash. Due to risk of theft. Okay, fine. All right, then we can move it on to the next one, impact 2. What else is he also going to need here? Well, he's going to need some change as well. Now that's known as having a float, a cash float, so that you can actually offer change to your customers. So he will need to have a float. All right. Okay, and literally then you can just say this is because he may need to offer change when receiving cash. Right, lovely. And once again, this is looking jolly good. All right, super. So that's another 4 marks in the bag, another 2 there, super. Right, so let's see what we've got next. Now, we've got some information on his statement of financial position. Okay, so assets and liability. Assets, remember, things that he owns. Liabilities, things that he owes. So let's have a little look at what we've got here. Damien needs to do some analysis of the enterprise finances. He asks you to help him complete the extract. Right, so we've got 2 bits of information that we've got to complete here. So firstly, we've got to establish what the net current assets are. Excuse me. All right. Now, net current assets, nice, easy calculation, also known as working capital. It just helps us to understand, can he actually cover his day-to-day costs of running his business? We can see his day-to-day kind of bills that he faces, 3,400. Meanwhile, he's got current assets of 7,450. So you want to show you're working here. So we can see it's 7,450 minus 3,400. And we can then put in the correct figure, of course, which is therefore 4,050. Okay, and we can highlight that down there as well. And then we've also got to consider the actual net assets position. Now, the net assets position, because we've already subtracted our liabilities in doing this calculation here, where we took our current assets and our current liabilities, we can literally take our fixed assets position and add that to our net current assets. So what does that then give us? Well, it literally gives us, 66,500 plus 4,050. So, of course, what does that equal? Well, that's going to give us 70,550. Okay, great stuff. Right, so Damien wants to know whether he has been able to pay his debts in recent years. He has given you the figures, the following figures for last year. So let's have a little look at what we've got here. Now, we've got the current ratio. So this is our liquidity ratio. This just helps us to understand how easily you can pay his day-to-day debts. So how do we work this out? Well, we've got the information there, and you'll be given this information. So we can see it's literally 9,000 divided by 6,000. So what does that therefore tell us? Well, it tells us that it's a ratio of 1.5 to 1. So therefore, he's got £1.50's worth of current assets, and remember, this is literally his current assets, so he has £1.50 of current assets to cover every pound of current liabilities, and then this is his current liabilities. So this tells us that he is liquid. His business is able to cover his day-to-day expenses of conducting his operations. Okay, fine, so that's looking all right. Now, next up, we've then got to do the liquid capital ratio. So we can see that the amount of his inventory is 5,400. So we've now got to put in this information. So we've got 9K there. We've got minus 5,400. And then we've got our current liabilities of 6,000, of course. So that means we can then subtract 9,000 minus 5,400 and divide that total by 6,000. And so what does that end up giving us? Well, it ends up giving us a ratio of 0.6 to 1. So this suggests really that he is holding a lot of stock. He's holding a lot of stock, and he probably could do with reducing that stock level and turning more of that stock into cash. So he's got about, £4,600 worth of cash there, okay, or other current assets, or 0.6. So those, basically, this isn't quite so good. He cannot cover his short-term debts without actually selling some of his stock. So that's the important takeaway there. Okay, so he's only got 60p of current assets without including the stock to cover his current liabilities. Right, so let's have a look at the next one. Damien has predicted what the financial state of his enterprise might look like in 2019. He's found the net profit is predicted to be minus 769. Give one potential cause of an enterprise's predicted net profit being negative. Okay, so having a negative net profit position, never going to be great. So what's the potential cause of this? Well, it could be a variety of things. Now, it might be that revenue is too low. We've already heard that his sales were falling, coming back to what we saw here. So his workshop sessions had fallen, but you don't need to worry about being as specific as that. So we could actually just say, right, revenue has fallen. That's fine. We could also say that cost of sales, so his cost of buying stock may have gone up. So his cost of sales may have risen. Or we could also say that his expenses are too high. So any of those answers would be absolutely fine for collecting another mark there. Okay, right. So let's move on to the next one. One method that Damien could use to improve his predicted net profit is to advertise the enterprise. Give one other action. an enterprise could take to overcome the cause of the predicted net profit being negative. So what else could he do? Well, he could, if he finds that his cost of sales has risen, he could actually try and reduce his cost of sales, could try and find a cheaper supplier, he could try and reduce his expenses, or he could try and increase his sales. Any of those really are going to be good answers. So what should we go for? Let's say reduce cost of sales. So if he is able to find a cheaper supplier, then that is going to be good news, as long as it doesn't affect the quality, of course, of the overall produce. Right, now we've got more of a developmental question, which is asking for explaining two advantages. So while this is 4 marks here, we can adapt much the same sort of structure that we were using on those 2-mark explain questions, where we give a point and then we develop that point. So Damien wants to invest in his candle making workshops by buying new equipment. He could save up to pay for this or take out a bank loan. Explain 2 advantages for the enterprise of using a loan to finance the new equipment. Okay, right, so first up, it means that this getting the loan is actually going to be fairly quick in terms of the actual process, and that means that he can actually get that cash inflow quickly, and he can actually start generating revenue using that money. So he's taking on this loan to enable him to actually earn more money. So that's a nice point. So let's just put that one down. So it means he can purchase equipment to increase revenue. Okay, right, to increase revenue. And now let's just develop that. Okay, this is because the loan can be arranged quickly, like he can apply online as well, of course, arranged quickly, allowing him to purchase equipment. Okay, fine. Right. Okay, jolly good. Now, second point, what can we explain there? Well, we could also say that a loan enables him to actually budget what his sort of potential expenses are likely to be. So he can make sure that he's got sufficient money to really cover the costs that he's facing. So it allows him to budget repayments. Okay, so he can budget his repayments, so that works nicely. Jolly good. Further to that, it means he can pay a set repayment every month on a direct debit. And so he knows that money is going to come out, and he can make sure he's got plenty of cash. Right, great stuff. Okay, so blank page. Right, now we've got a bit on break even. Let's just get that lined up, the camera. Right, okay, so Damien wants to ensure he will get enough customers to cover the costs of running the candle making workshops. His forecast number of people he thinks will attend. Damien has produced a break-even chart. Okay, fine. Label the lines marked A and B in the break-even chart. Okay, so of course line A, well, this is about sales revenue, isn't it? This is the cash sale, well, not even the cash sales, just the general sales incurred by the business. And this line here is the actual total cost that the business faces. So we've got total revenue and we've got total cost. This is the money coming in, this is the money going out. It's just worth us making sure that we're okay with each of these areas. This is where revenue is greater than costs, so that's our profit. this whole triangle down here reflects the loss. This point here is, of course, our break-even point. So let's just highlight that. Of course, you don't need to do this in the exam. I'm just helping you with your revision here. This means you can target the fact that he needs £1,000 to break even, or he needs to sell 40 workshops to break even. Okay, if he sells 60 workshops, well, look what sort of income he gets. He gets like 1,500 and faces costs of 1,200, giving him a £300 profit, i.e. the vertical difference there. Okay, so you can use these graphs to interpret quite a bit of information. All right, lovely stuff. Identify the number of customers required to break even. So there it is, 40. Okay, we've just talked about that. And then the margin of safety shows the number of sales that the enterprise has above the break-even point, calculated using this formula. Isn't this nice to be given this? Okay, never used to be given this information. So the number of sales is, of course, 60. 55 rather. I didn't read the rest of the question. There's a clear lesson there. Right, okay, so we got 55. We know the break-even point's there. So the margin of safety is simply the difference between there and there. How many is it? Well, of course, 55 minus and 55 minus 40 is, of course, going to be 15. Okay, so that is his margin of safety. Right, great. Okay. Next up, explain two limitations. So what are two potential limitations for an enterprise break-even analysis? Okay, so once again, we've got to give a point and then explain that point. Okay, so it may be the fact that it is a forecast, okay, forecast of costs and revenues, okay, and we know that costs may change. Okay, so there's an issue there. Costs may change, and what does that mean? Well, it means that the break-even graph is then wrong. Okay, so break-even point will change. Okay, all right. Right, what else could we also say? Well, we could also say that it assumes really that there's not going to be any sort of competition or anything, okay? So it assumes a stable external environment. Whereas if a brand new competitor opened up next door to him, this is going to be bad news in terms of him actually attaining his break-even point, isn't it? Okay, so yeah, we can then say, right, a new competitor may mean that break-even, the break-even point becomes harder to attain, or that of course you could need to change your prices and reduce your prices, becomes harder to attain. Right, so if you need to reduce your prices, well, that's going to change your break even once again, isn't it? Okay, so any answer along those lines, all right, is absolutely fine. Right, so let's move it on, see what we've got next. Damien needs to know what he should include in the cash flow forecast, and in particular in the cash outflows. Right, so give two examples of cash